Welcome to the deep dive. We're here to synthesize the latest data, cut through the noise, and get you right up to speed on the big shifts happening globally. Today, we're zooming in on Asia, specifically the really rapid changes in the tax landscape across the continent. And if you're an investor, maybe you own property in Southeast Asia, or perhaps you're thinking about a long-term move, maybe retirement, listen up because the financial rules you thought you knew, they've changed drastically. And Thailand is really at the center of this. Our mission today is pretty straightforward. Pull out the key takeaways from our sources, give you a clear picture of this new tax reality. We'll focus on what it means for investors, long-term residents, anyone relying on foreign savings.
Yeah, and we've looked at quite a range of material here, stuff covering government policy shifts, global economic trends, basically everything that's reshaping how attractive Asia is for expats right now.
Yeah.
What's really clear, though, across the board, is governments are buckling down on domestic revenue. And for a lot of them, that means getting stricter about foreign income. So yeah, our main focus has to be Thailand's, recent reinterpretation of its personal income tax rules kicked in this year, January 2024. And it's not just a minor adjustment, it's really a fundamental change for anyone doing financial planning in that region.
Okay, let's dig right into that. The biggest change, the one effective January 2024. For years, decades even, there was this pretty common strategy expats used, income earned outside Thailand. You only paid Thai tax on it if you transferred it into the country in the same year you earned it. So people just waited.
Exactly. They structure their finances around delaying those transfers. Simple workaround.
But that strategy is now, completely gone. The Thai Revenue Department has put out official clarification. It fundamentally changes how they view taxable income transfers.
Right. And this is the critical point that so many long-term residents and potential residents are grappling with now. The new rule says all overseas income you bring into Thailand is subject to tax. It doesn't matter when you earned it.
Wait, even if I earned it years ago?
Yes, that's the kicker. Income you earned 5, maybe 10 years ago, kept in a foreign account. If you transfer it now, it falls under the new rule.
Wow.
Think about, say, a retired couple. They transfer $100,000 in dividends they earned and kept offshore 5 years back. Old rule, tax-free transfer. Under the new interpretation, that whole amount could be subject to Thai personal income tax. It completely flips the script on planning.
Okay.
It really means you need much tighter bookkeeping. You have to manage your finances with a lot more precision than before.
Let me just clarify this for everyone listening. Is there any kind of grandfathering, any exception for, old savings already accumulated?
There is one crucial caveat, and it's really important.
Okay.
Savings that you accumulated in your foreign accounts before December 31st, 2023. So basically, money earned up until the end of last year that remains exempt from this new transferred income tax rule.
Ah, okay. So there's a cutoff.
Exactly. But any income earned from January 1st, 2024 onwards, whenever you bring that into Thailand, it's potentially liable. That date, December 31st, 2023, is now absolutely critical for your financial records.
That distinction is vital. Pre and post January 1st, 2024 earnings. Huge difference. Okay, let's shift to who this affects. Lots of expats probably assume their visa-type retirement, investor, whatever, dictates their tax status. But the sources say that's a big mistake, right?
It really is a common misconception. The key factor determining your tax liability in Thailand isn't the type of visa you hold. It's purely about how long you stay.
Okay, so what's the threshold? What's the magic number of days?
It's purely time-based. If you reside in Thailand for 180 days or more within a single calendar year, boom, you're considered a tax resident for that year. Pretty much half the year. Once you hit that mark, you fall under this new tax regime for any foreign income transferred in that year, regardless of your passport or visa.
I can see huge implications there, especially like you mentioned, for property owners. Let's say someone owns a nice villa down in Phuket. They get their pension or maybe a salary paid abroad, but they love Thailand, spend 7 months a year enjoying their place. Does that trigger this?
Precisely. That 180-day presence makes them a tax resident, even if their main income is earned entirely outside Thailand.
Right.
Spending those 180-plus days means any foreign income they transfer in that calendar year becomes potentially taxable under the new rules.
Yay.
And it's crucial to remember, any income earned inside Thailand, like, say, rental income from that Phuket villa that's always been taxable, regardless of how long you stay, that hasn't changed.
Okay.
But what's really striking is how this purely time-based trigger forces people, the snowbirds or long-stay folks, to become meticulous clock watchers.
Yeah, I bet.
Suddenly, doing a visa run isn't just about immigration stamps. It's a critical financial move if you want to avoid being classified as a resident for tax purposes.
Hmm. So is the government trying to, I don't know, nudge out long stay retirees? Or is it just about needing the money, post-pandemic budget balancing?
It feels like a mix, but the primary driver seems to be fiscal need.
Yeah.
Yeah, and also bringing Thailand more in line with international norms. Thailand used to be quite unusual in Southeast Asia for being so lenient on transferred foreign income. This change actually brings them closer to how many other countries operate.
Okay.
But to really grasp the impact, you have to zoom out a bit, see how this Thai shift changes the whole competitive landscape in Asia for attracting talent, expats, and wealth.
Right, because now people might look elsewhere. And Asia's tax scene is incredibly varied, isn't it? These changes are definitely making expats rethink their options. Our sources highlight some really stark contrasts, like you've got the UAE over there, still a massive draw with zero personal income tax.
Right, even though they did bring in a 9% corporate tax recently.
Uh,
But for individuals, still zero.
and then you have places like Singapore and Hong Kong, economic giants. How do they compare?
Well, Singapore and Hong Kong run on what's called a territorial tax system,
Uh-huh.
and this is key.
Territorial, meaning?
It basically means they primarily tax income generated within their borders.
Hmm.
So money you earn from foreign sources, generally it remains tax-free locally.
Ah, okay. Big difference from Thailand's new approach to transferred income.
Huge difference, which obviously makes Singapore and Hong Kong very appealing for, high net worth individuals whose wealth comes from international activities.
That makes sense.
And there's another factor, the overall cost of just employing people. This affects where companies decide to set up shop, which means jobs. The sources point out that Japan and China are actually the most expensive places globally to employ mid-level expats right now.
So even if you personally aren't planning a move to Tokyo or Shanghai, the fact that big companies might reconsider those locations, that has knock-on effects across the region.
Absolutely. It influences the whole regional job market, the competition for skilled workers everywhere in Asia, including Southeast Asia.
So where are people looking now, potentially, instead of Thailand?
Well, these shifts are definitely driving interest towards countries perceived as having maybe simpler or more lenient tax policies right now. We're seeing buzz around places like Malaysia, maybe Vietnam, as potentially attractive alternatives. They might have favorable tax treaties or just haven't tightened the screws on transferred foreign savings quite like Thailand has just done.
Interesting.
And this ripple effect, it goes wider than you might think, even touches the tourism industry.
How so?
Well, if staying long-term, like year-round, suddenly gets way more complicated and expensive because of these tax rules, the travel industry might need to pivot. Maybe focus less on attracting permanent residents and more on promoting, say, extended holidays or flexible shorter stays, adapting their packages.
Right. Shifting from residents to perhaps super long stay tourists.
Something like that, yeah.
Okay, so let's bring it back to the individual. What does all this actually mean for someone planning that move or already living long-term in the region? The big takeaway seems to be complexity. The easy days are over.
That's definitely the message. The sources really hammer home 3 crucial steps now for anyone affected. For compliance, for just sensible financial planning. First, keep meticulous financial records. Absolutely non-negotiable. You have to be able to clearly show what income was earned before that December 31st, 2023 cutoff.
Because otherwise, the tax authorities might just assume it's all taxable.
They could certainly challenge it. The burden of proof is likely on you. So records are key.
Makes sense. And step 2, I'm guessing don't try this at home.
Pretty much. Step 2, get professional local tax advice. Immediately. Especially if you're dealing with significant amounts of money or complex income streams. International tax law is tricky. It changes, and it really depends on the specifics of where money was earned, where it's going.
Right.
And third, just understand that these rules aren't set in stone. They're dynamic. Governments adapt. So expats need to be adaptable too. It's almost a financial requirement now.
But it's not all snicks, maybe some carrots too. The Thai government isn't just making things harder for foreign residents, right? They're also trying to lure some people back.
Yes, that's the other side of the coin. They're actively trying to combat brain drain, skilled Thais leaving or staying abroad. They've rolled out some pretty significant incentives to attract Thai professionals back home.
Okay, what kind of incentives?
It shows they're thinking about attracting specific kinds of talent, perhaps realizing they risk losing some foreign capital or residence. The main one is a special flat 17% income tax rate. It's fixed, quite attractive compared to the standard progressive rates.
For any returning Thai national?
No, it's targeted. For returning Thai professionals who have specific high-level qualifications or expertise in certain fields the government wants to boost.
And there are perks for companies hiring them, too.
That's right. Employers who hire these qualified returning Thais can also get tax exemptions. So it encourages the private sector to actively recruit this talent back.
So it's a clear strategy. Boost internal innovation, internal economic growth, while maybe making the tax base broader with the foreign income rules. Shows they know they need to compete.
Exactly. It's all part of that bigger picture trend across Asia. Governments trying to juggle global competitiveness, attracting the best talent with their own domestic budget needs. Adaptability, as we said, is not just a nice to have for expats anymore. It's essential for financial health in this environment.
Which brings us to the final takeaway for you listening today. Whether you're buying that holiday home, making investments, or planning retirement in, say, Thailand, you absolutely must understand that 180-day residency rule now. And the new game regarding transferred foreign savings. The idea of Southeast Asia being an automatic, easy tax shelter, that era is, well, definitively over.
Yeah. And given how just a seemingly small clarification,
Mm-hmm.
like that rule about when income was earned impacting its taxability upon transfer, can completely upend years of financial planning.
Mm-hmm.
It really makes you wonder, doesn't it? What other little piece of regulatory fine print might be lurking in your target country, whether it's Malaysia, Vietnam, somewhere else? What might be the next rule to shift unexpectedly?
That's a critical question. Smart planning now really has to factor in that potential for change, that
Ditto.
dynamism.
Absolutely.
And that is the complex thought we'll leave you with today. If you do need help navigating all this, figuring out your specific situation, making sure your plan is solid for this new Asian tax reality, we've pointed you towards some resources. Take the next step. Go check out movehandstay.com/request. You can find more customized information there. Get connected with professional help to deal with these very rapidly changing regulations. Thanks for joining us. We'll see you next time for the next deep dive.